All right. What is up, tycoons? What's up, traders? Super excited for today's video. We have to talk about TLT. Okay, now TLT is seeing two extremely red days in a row, really three. And there's a lot of interesting developments. And we just finally filled our first gap to the downside that we were looking for the gap fill. We just filled this gap right here. All right. And we have another one all the way down here, right around $95, which does take us right around here to our wave 5 targets for this bearish move to the downside. We're going to see if that can complete. We're also going to zoom in. All right, so you guys can see a couple of the different trading structures and trading ideas that I've been using for TLT. All right, we're going to take a look. We have a similar pattern that we saw right over here in the past. We're going to see what can happen and, what's really going to happen right around this time. All right, so nice detailed technical analysis, but I don't want you guys to get fooled, okay? That's why that is the title of today's video. And rates are going to be higher for longer. Okay. We had some interesting data that came out today as well as yesterday. All right. And really crashed the bond market. And we're seeing interest rates still hike. All right. And we can see that this long-term downtrend, okay, pretty much appears to be over, right? When we look at the 10-year, all right, there's a huge shift over the past several years. And the 10-year monthly chart, even you can see, just these really, really, big shifts in the environment. We're going to go ahead and break down, what that potentially means for stocks. All right. And we're going to take a look at this high interest rate period. Look at here in the 50s, guys, what interest rates were doing. And we'll actually compare that to what the stock market did back in that time. And we'll take a look at possibly what could become doing for the market here in the future. All right, going over some much more broader and macro data as well. Okay, so really diving into stocks and treasuries, and then also giving you guys some nice detailed technical analysis. All right, so as always, the content provided on this channel is for informational and educational purposes only, and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. Today's video is sponsored by Simply Wall Street. It's a really great platform. They have an amazing website and an amazing app. You can find more about it, all right, and get a 14-day free trial as well as up to 40% off for the first 100 people that join using the link in the description and pinned comment down below. And you can always email me for a one-on-one personal session, guys, at zachleytrades@gmail.com. If you're ever interested in doing a one-on-one session, just feel free to shoot me an email, okay? So let's go ahead and get into this daily structure that we have here. We had this very large, and really tightening triangle pattern here. And eventually we got the breakdown, right? We're being patient, waiting to see where we're going to break to the upside, where we're going to break to the downside, right? We have gaps up here, we have gaps down here. And really, we know that price action is going to be drawn towards these gaps. And so, our job was really just to be patient and wait for a clear sign if we're going to break to the upside or to the downside. We've clearly broken to the downside. And markets tend to move in 3-wave and 5-wave structures. So we're going to see if this turns into a bearish 5-wave structure right here. All right. Wave 3 hit right around the targets, and then we got a strong bounce up for wave 4. And it appears we've started our wave 5 down, officially putting in a low and now a lower low. So we're going to see, is this downtrend going to take us down here to fill our targets of right around at 97 to about $95 is roughly going to be the area on TLT. As you can see, this big blue box right here, this is a huge gap. These gaps, they tend to fill about 90% of the time. The big question is when, right? So when interest rates start falling, all right, and maybe we start seeing interest rate cuts, that's when you could expect maybe this gap up here to fill, right? But in an environment where interest rates are still going to be going higher, treasury yields are still going to be going higher, that would most likely push it to fill this gap down here, right around that $95 area on TLT. Okay, so I'm actually going to be really, really interested in that and to see whether or not that happens. Okay, so that's it from, more of a broad base, right? We had, following TLT for a very long time. It's been following the analysis pretty well. What we're going to see now, if we zoom in, all right. We do have some bullish divergence right here. Okay. So I have it highlighted on the chart, but if you're not familiar with how to tell, all right, take a look right here. We have a low, and then here we have a lower low indicated by the circles, right? When if you look at your RSI, we have a low, and then we actually have a higher low. So that's a bullish divergence, very simple term. All right. When the price action is making lower lows, but the RSI is making higher lows, you're increasing in relative strength as the price is going lower, and it's a bullish divergence. Okay. Take a look right here, highlighted by the circles again. We have a low, and then we have a lower low. We have a low here, and then we have a higher low here. So we do have a similar setup to what we had in the past with the bullish divergence. So we're going to see if potentially TLT gets a little bit of a short-term bounce, right? If you notice, we definitely have a new gap up to fill, okay? If we chart right here, we can see we have a new gap on the chart in between these two candlesticks, and we're going to see what happens, all right? A lot of times the gaps have been filling relatively quickly. These days, you see we had a gap down here, and then the next day we ended up filling that gap. So it'll be interesting to see what happens. Now, not only do we have the bullish divergence, but we also potentially have a abandoned baby chart pattern, okay? And that's going to be these three candlesticks right here. So notice how we have this red one, and then you have this candlestick here after the gap down, okay? And then you have the gap up afterwards. That's what's known as an abandoned baby. So where you gap down and then you end up gapping back up over the gap. All right, that would be an abandoned baby. And that's what we had over here that led to a really, really strong and, magnificent rally. We actually bought call options here on TLT. And it was a very, very successful trade, right? So, the key differences from here, okay, to here is not only did we have the bullish divergence, okay, and the abandoned baby pattern, but we also got a MACD crossover on the MACD, right? Where the red line crosses up above. That's usually a bullish signal. Here, what worries me, okay, also is that this candle is green here. This candle is red. So we have a red candle abandoned baby with the bullish divergence. And then we also have a MACD crossover to the downside now. And that's usually a sell signal, right? In my last TLT video, I highlighted that, hey, we started to curl down. This could be a sell signal. We have this gap down here to fill. And if you take a look and we were to draw a line, a straight line directly across, you can see that's exactly where we came down, right? We came exactly down to fill the rest of that gap down that we needed to fill. And so we'll see, will that gap fill act as a little bit of a support? And can we get the bounce up? And if we gap up higher, okay, tomorrow, potentially we could see that turn into an abandoned baby pattern, right? But for now, at the moment, we're not really getting confirmation of that. Okay. We're just going to have to see what happens on Friday. We have non-farm payrolls tomorrow, NFP. The labor reports today really crashed the market, both in the bond market and in stocks. We saw a really big drop. So, there is a chance that we could see a really good move to the upside, based off that abandoned baby and bullish divergence. But remember, it's not quite as clean of a bullish setup as it was last time over here. We had a green abandoned baby. This one is red. All right. We have the bullish divergence, but the MACD is crossing over to the downside now versus the MACD crossing over to the upside. So these are just things you want to take in mind and keep into consideration. If we were to get a little bit of a dead cat bounce and then pull back down lower, that really wouldn't surprise me at all. Okay. So that's pretty much the main things that I'm looking at on TLT right now. I was kind of playing this both ways, right? I had some puts, all right, that obviously those puts played out really, really well. I got 125% on the puts. But that was honestly more of my hedge, and I had some larger call options, okay, to see if we are going to get a short-term bounce before pulling back down more. And so, the puts did really well. The calls did not. So, that's why you hedge yourself, and options have, offer a lot of variety in different ways that you can hedge yourself. So, I was able to walk out of that relatively undamaged. You got to take your losses when it's time to take your losses. And, that's why you hedge, to protect yourself and, make your losses smaller than what they would have been if you were just going into a trade with no type of setup, right? So we're going to see what happens in TLT now. All right, after today, again, another brutal day. Let's talk about some of the macro trends right now, right? So when we look at the 10-year yield, to me, in my opinion, the low interest rate, environment and era that we've really had for a long time, and low yield environment, I think that that's really gone now. If I'm being honest, we're seeing, if you take a look at this, right, this is foreshadowing a weakening trend here. And then we had a false breakout here. And really, we've just, completely smashed through this trend right here now. And, we're in a much higher place. And not saying that, interest rates have to keep going up forever, right? I'm not saying they're going to keep going up and up and up and up. But, what I am saying is that, some consolidation around this period and just above this overall trend line seems very reasonable, if anything, right? Like that's what we would get. And so, really what we're seeing here is that numerous market axioms no longer apply, right? And basically, this is an axiom is just a statement of proposition, which is regarded as being established, accepted, or self-evidently true, right? And so we see that there's been a large shift here over the past several years, okay? This right here looks way different than this over here. That's essentially what we're seeing, and that the secular downtrend in interest rates appears to be over, right? And you can see here, in 1982 to 2020, we had a secular bull market in bonds and balanced portfolios during this time period, right? During that downtrend, during that really big downtrend that we had in, the 10-year yield, okay? And so basically with treasury yields going down, we saw both a bull market in bonds and in stocks, right? So your typical 60-40 portfolio did really, really well. Now, here recently, your typical 60-40 portfolio has been absolutely crushed because not only did bonds get crushed, but also stocks got crushed, right? So basically, what's happened, right, is we've seen a major shift for all investors and money managers. Okay. That's what this is right here. This new high yield environment that we're in right now and that we're possibly going to stay in for a while. This is really causing a big major shift for, all investors of every type and for money managers as well. Right. So, a lot of the money managers are coming in and there's going to be some big changes there essentially as well. Right. Now, when you look at the 2000.com bear market, okay, bonds, right, did pretty well, right? They held up pretty well. 38% and 41% return compared to the S&P's negative 49%. Now, in the '09 crisis, you see the S&P dropped 56% and bonds went up about 25% and 20% right here. In the 2021 to 2022 inflation market, what we see is that both bonds and stocks got absolutely crushed, right? And so that's really, kind of what I'm going over and just, sharing with you guys is that the big change right now, okay, is because we're seeing that the long-term secular downtrend and long-term secular bull market in bonds appears to be over, right? And we're moving into a new environment now where things are going to be different. And I expect this to last and for this to be another new era, right? If we go back to this chart, okay, this is from the 80s all the way here to the 2020s. So this is like a 40-year secular, trend that we have right here that we've broken. And so, we're going to enter this new period. I don't know how long it's going to be. Maybe it'll be 5 years, maybe it'll be 10, 15, 20 years. But this is definitely going to be a shift. So if you take a look at this as well, this is the 7 to 10-year treasuries anchored VWAP. All right. And this is on the monthly chart. And if you take a look, what's significant about the anchored VWAP is, we're basically flipping it right now. Okay. And so we're flipping this to resistance, which is not a good sign. Okay. And if this is going to be resistance, then it implies that we're going to be in a downtrend, right? And we're going to start to see a downtrend on a monthly time frame from the typical bull market that we've been in, throughout this really, really long time here, right? You can see each time you come down to the anchored VWAP, you got a nice little bounce, and then we establish that we're in a strong bull market, trending upwards throughout this time period. And now, again, we're seeing a shift where we're now trading below the anchored VWAP, and we could start to actually be heading lower. So these are just some things to consider for people investing into bonds and things like TLT and TMF. I've been waiting to pull the trigger on TMF, and the more I wait to pull the trigger, the happier I am that I waited to pull the trigger because it really seems like we're getting a much bigger shift right now. And a lot of people don't seem to realize the things that Powell is saying when he says that, we're going to a new environment where rates are going to be higher for longer. I think that people think that, he's just talking about a couple months. Even though they've already paused, they're talking about raising rates again. And even when they do pause, that doesn't mean that a cut is going to be immediately around the corner and that we're going to actually even see drastic cuts, right? With the labor market being so strong, it gives them more room and more flexibility to be tighter and tighter on monetary policy and really not have to loosen up. And so, we could go through a period where the Fed funds rate is going to, remain elevated at a higher level than we've been used to, right? We were previously at zero, okay, and going from those extremes, we're going to go to new extremes, right? Which is what we've done. We've increased the rates at the fastest pace ever, and it's going to reach an equilibrium, but that equilibrium is going to be much higher, than people have been used to in the past. Now, let's look at a period where long-term interest rates were really skyrocketing, right? We can see here through the 50s up to the 80s, this huge, huge spike in long-term interest rates. Now, why am I showing you this? Okay. Well, the reason being is because we want to take a look at how did the stock market perform in the 50s? Okay. Because, a lot of people think that if interest rates are going to go up, all right, and bonds are going to go down, that the stock market has to go down as well. But we can see here we have a nice secular bull market in the 50s lasting about 20 years, right? About a 20-year bull market here, on the S&P 500. And when we take a look here at 2012 through 2023, it appears that we're still in that long-term secular bull market. Okay. We came down here, got a nice bounce right off our average here, and we're continuing to move up. This is the monthly chart with the 50 moving average. And you can see that a strong bounce and a hold and a stand at that 50 moving average indicates that longer term secular bull trend is still active, right? Versus when we just looked at the 7 to 10-year treasuries, they actually flipped our key level here, and we're starting to show a downtrend. So it doesn't have to be all doom and gloom for the stock market just because interest rates are going higher and we're going to be in a new higher rate environment. I actually want to take a look here and show you guys some really amazing data. All right. So this is where we're at here currently. All right, and you can see we have these long periods of consolidation here. All right, and we go through another long period of consolidation here, another long period of consolidation here, but we have this massive secular bull markets in between, right, where the market is really, really just raging, right, absolutely raging, and it appears that we're essentially halfway through one of these right now. Now, why am I showing you guys that? Well, because if you take a look here, the S&P still went up an additional 142% from the halfway point, all right, to the peak, right? Same thing over here. The NASDAQ actually just completely obliterated, okay? And tech is really probably where you want to be right now if you're looking for if you think that we're going to be in a long-term secular bull market, especially due to AI. But look at the time period here. The NASDAQ gained an additional 1,190%. Now, remember, these are monthly charts, okay? So these are longer time frames. And this right here is basically from the 90s up till 2000, till we saw the dot-com bubble, all right? 1,190%. The S&P gained an additional 142% in this time here during the 50s up until right about 75, okay? So, it's going to be really interesting to see if I was to take a guess at were we going to get returns like this or were we going to get returns like this, I would go much more with this. And the reason being is because we take a look and we saw that, the long-term secular downtrend in treasury yields seems to be over. Okay. And this is that period here in the 50s when the stock market was still in a secular bull market. So, if this is going to be right, we could potentially see another 142% gains in the stock market, okay, that would last up until about 2034 to 2035. Now, this doesn't mean you don't have corrections along the way. All right, you can see that there's many corrections along the way, but when we're speaking of long-term bear markets and long-term periods of consolidation and pain, it appears that, we're really just got a healthy correction and we're potentially going to still continue with more corrections up until about 2034 or 2035. And based on, the treasury rates and looking at those and comparing how the S&P performed back in that time period, it appears that we could potentially, if history wants to repeat itself, see around 100 to 142% gains in the stock market, up to about 2035, right? And so that would give us essentially another 10 years roughly of potential gains in the market. So, when you look when you take a step back and you look at, much more of the macro data and you stop looking at the day to day so much, you start to see a clearer picture being presented, right? We typically get these 26 and 27-year secular bull markets, and then you get these bear markets and periods of consolidation. And then you go through another 26, 27-year. And so we're right around halfway through that period right now, which would again take us right around to 2034 or 2035. Okay. Now, something else I want to show you guys, which I've showed in a previous video. If we take a look here, all right, at the 200-day percent deviation, which this is your 200-day moving average, right? The returns on the NASDAQ, when you're above this 20% level, okay, meaning that, there's a 20% deviation over the 200-day moving average, 12 months out, the NASDAQ has returned 24.9%. Okay, that is crazy gains, guys. All right. Really, really massive gains. And so that's suggesting that, next summer, by next summer, we could see the NASDAQ up an additional 24.9%. Now, again, does this data have to repeat itself? Do these, does past performance indicate, future performance? No. But these are just some of the facts, right? And these are just like the average facts that what has happened, right? And so, everybody's saying everything is super overbought. We saw a massive pullback in the stock market today. A lot of things went on sale. And, I scooped up a couple of plays along the way, right? I did grab some Apple for heading into earnings. Probably going to sell those before earnings, maybe. Those are already up 30%, right? Just from buying the dip this morning in some solid things. And there's a couple other plays that I'm in right now for earnings. There's a lot of things on sale today. There's more data coming out tomorrow. Things might go back on sale again. But when you look at some of this data, it shows that things really could still be bullish along the way. All right. If you take a look at the S&P 500 using the same statistics, now this is the 200-day percentage deviation. And when it's over 10%, 12 months out, the S&P is up an additional 11%. So again, really, really big numbers there, guys. And, it's summer right now, right? It's July right now. So we'd be looking to potentially see some of these returns by next summer, right? So by next summer, maybe the S&P is up an additional 11% from where it's at now. And then by next summer, maybe the NASDAQ is up an additional 24.9% from where it is right now. Now, that doesn't have to happen again, but, numbers don't lie. And these are the numbers that I'm looking at right now. Hopefully you guys enjoyed this video and appreciated it. If you did, smash that like button and subscribe to the channel. With that being said, I'm out.